Well, welcome everybody. Here we are into our next quarter review. Thanks for joining. What we were just saying earlier is it's nice to see some faces and see people on the call, whether it's the names or the faces we can see. It always adds a little value to not be staring at the black box that Mike and I used to do all the time in the past. So thanks for joining us. I'm Debbie Dabrowski. I'm the CFO of the Vermont Community Foundation, and I'm going to turn this over to Mike Miller with Crucial Partners. I think, is it Crucial Partners, Mike, or Crucial Consulting? I know it's
Partners.
Crucial.
Partners, you got it.
There we go. And Mike has been with a consultant for the VCF for 20 years, I think.
Yeah, this is 21 actually. Almost 20. Almost 20.
Almost 20.
You're right. So I can get that right. I can do math.
We've had a long journey with Mike. He's been with us and the firm's with us for many ups and downs. And, after last year, we were back into an up. So on that note, Mike, I'm going to turn it over to you and you can take it away.
Great. Thanks, Deb. And good morning, everyone. Really, really nice to see many of you. I'm going to just share my screen. Hopefully this is going to work. I assume everyone can see that okay? Good. So as Deb said, my name is Michael Miller. I'm the Chief Investment Officer with Crucial Partners. We were formerly named Colonial Consulting. We changed our name to reflect a little bit more about who we are as people and what we believe in. And we've had the honor, as Deb said, of working for the foundation for we're closing in on 20 years, which has been just a great journey for us. And I'm glad to say, as Deb also said, that we are in the midst of a really strong upswing for the portfolio, which is always pleasant as opposed to the other way around. And we'll talk a little more about that as we proceed through some of these slides. As usual, please at any time, if you want to in the chat, or if I can somehow grab my attention, I can't really see everyone on the screen. Please, at any point in time, I'm happy to stop and answer any questions you have, and I'll also, of course, be happy to do that at the end as well. So what we put up on the screen here for you are the performance results of the three pools. The long-term pool is basically an unscreened pool that pursues an endowment type strategy. The socially responsible pool is a screened pool that's aligned with the foundation's values that essentially also pursues an endowment type strategy. We'll look at the differences in those pools, both returns and asset mix here and a little later. And then the midterm pool was constructed for essentially shorter philanthropic horizons, i.e. not endowments. So there's more bonds in that pools we'll look at. Over time, it should have lower returns than the other two pools if we do everything else right. And the markets cooperate, of course, too. And that pool is meant to not be as volatile, because if you're taking capital out of your portfolio on a regular basis to a larger extent, market risk can be a really significant problem if you happen to be needing that capital or wanting to distribute that capital at a time when the markets are doing poorly. So first thing you'll see, for each pool, we've listed what we call a custom benchmark. That takes the portfolio's asset mix, which we'll also look at in a second, and assigns an index fund to each piece of it. So it's essentially what would the returns have been if the investment committees and the foundation's investment strategy, which is implemented through index funds. And one of the things, as you can see with about in a minute, is that the portfolio for the most part has meaningfully outperformed its benchmarks over time. And that's obviously one of the reasons that we still have a tenure with the foundation, and two, that we don't have more of the money in index funds. Index funds are, by the way, for the vast majority of cases, the much better answer. But the foundation has a very unique approach, a very unique type of managers it uses, and it has the patience and the time horizon and the rigor at the committee level, and hopefully through us, to basically find and stick with really good investors over time. It doesn't always work, but it works more often than not, as we'll talk about in a minute. So here you can see the pool, for example, the long-term pool year to date up 9.6%. That's 1.4% above its benchmark. I'll give you a quick update through last night. The pool's now actually up 13.5%, which is a whopping 4% above its benchmark. The reason it went up as much as it did was in part some manager issues in August, and two, we have some private equity in this portfolio, and these returns that you see here didn't include June private equity numbers yet, and they've been extremely strong. In fact, we don't even have them all in the 13.5 I just mentioned, so that number will probably proceed on its way closer to 14. But what you can also see is that for the year, the portfolio had a stunning 30% return. versus 26.3 for its benchmark. 3 years is the only time period here where the portfolio is underperformed. That's a function of really two things. One is it has a value bias, which we can talk about a little later. And by a value bias, I mean it's oriented towards owning cheaper, out of favor stocks. You didn't want to invest that way the last few years. You wanted to have a growth tech bias for sure. You wanted to own as much Amazon and Apple as possible, and some Tesla to throw into the mix and everything else. And we don't just own that much. We own very little of any of those. And so that has definitely created some of a little gap in our record here, as you can see, but we're pretty excited about where things are heading in terms of the recovery of that gap that you see there. And then you can see across the page, the longer term numbers are all well above the benchmarks. This is all net of investment management fees, just to be clear. And we'll talk a little bit more about what this translates to in a minute. The SR pool is the same story, a lot of great outperformance. That pool's up around 10% now year to date through last night. And then the midterm pool is the weakest performer here over 3 years and 5 years, but not by much. And actually, that's the big surprise in this portfolio is if someone had asked me what the midterm pool's 5-year returns would have looked like 5 years ago, I would not have thought 8.5% was even remotely possible with so many bonds. But we live in a weird world of low interest rates that stay low forever. It seems like I'm being a little sarcastic when I say that, but the fact is it's just a very, very interesting time. And it's a lot, there's a lot of lessons to take from this time. One last thing on the midterm pool before we move on. This pool is almost entirely indexed, so it does not use the active managers that the socially responsible pool, the long-term pool does. So when it deviates from the index, as you can see, for example, over 5 years, that's because we've done a couple of things that are different. One of which is to use some shorter duration bonds and not all long duration bonds. And the indexes don't actually track perfectly either. So that creates a little bit of noise, which you can see in the 1 year and the 3 year numbers. But nevertheless, that's an index pool. So that one's not about really whether we're picking good managers or not. And it's really just there, as I mentioned earlier, to provide a really good alternative to the long-term, more volatile pools above. So we flip to the next slide. I just want to put the long-term pools numbers in a little more perspective. And what this does is it takes the numbers you just saw a minute ago and essentially converts them to cumulative returns. So if I go back for a second, we'll use the 15 years, for example. The pool returns 7.6%. Its benchmark returns 6.3%. That's per year. If you look at this page, that turns into 201.7%, and the benchmark is the red, 148.6%. So the only difference between these two numbers are the exact same. They're not the same numbers, but they're the exact same thing, which is the performance of the pools, net of fees, and they reflect compounding. And this is why when you go back to here, when we can add 0.5, 0.7, 1.5% per year over an index, it doesn't look like that much here, but it turns into a ton of return here. And that's why it's not worth trying if you fail, but if you can succeed, it's very much worth doing. And that's our point. There's one other thing I didn't address before, which I want to really make a big deal about on this graph. Take a look at the orange bars here. So this is CPI plus 5%. We spend a lot of time in my world thinking about, well, how do we do better than other endowments and foundations? How do we do better than the benchmark? I mean, how do we keep our job? How do we keep you happy as constituents of the foundation? How do we keep everyone happy? And a lot of it is about the relative return because there's an investable alternative, the index funds. But the reality is, on top of that issue, which is certainly important, sustaining and preserving and enhancing purchasing power of these assets, their actual philanthropic purpose, is actually much, much more important. I don't think anybody in this call would agree with the following statement, but I'm going to make it just for fun. If we underperformed our benchmark by 1% a year, but we added 3% a year over the CPI plus 5, I don't think everyone would be thrilled, but we'd actually pretty much be able to hold our heads up high and say, well, we did actually grow the value of your philanthropy in the state of Vermont and wherever else you are focused. And so that's an interesting thought experiment. It's not a real one, though, because we don't want that outcome. But what you see here is the exact outcome we're looking for. So you can look at any of the bars you want, but let's look at since April 1, 2002. That was our official, like the portfolio started to change over date. That's the 20 years reference before that was made by Debbie and I. So the portfolios returned 328% net of fees. The benchmark's 234, fine. But the bigger issue is that middle bar, 295.2. That's the CPI plus 5 or inflation plus 5%. And what this comparison is telling you is that if we had just earned the index's returns, we would have actually had a pretty significant shortfall in terms of the growth of the real value, the inflation adjusted value of your capital after spending as it exists at the foundation. But that added value that came from the diversification we'll talk about, the strategy we'll talk about, the managers we'll talk about, essentially took a failure and turned it into a pretty significant success. And you know, this is literally, if we could draw a bar and make one up, this is how we'd want to make it up. And it's obviously, this is not made up. This is the actual results of the foundation, just to be clear. So this is something we're really proud of, which is why I want to spend a couple of minutes on this one for sure. And you can see across the page, one last thing I'll point out, the 3-year column where we looked at the underperformance before, that now translates into what you see here, the 31.9% gain versus the 36% gain for the benchmark. Better than the 25.5, so we're not too miserable about that, but we don't like it. But it's just really interesting when you look at that gap and compare it to the premiums to the long term. In a perfect world, we'd be consistent, right? We would never underperform. We always deliver better performance, but that doesn't happen in the real world. You have to take on risks that make you different than an index, and you're going to at times look like you don't know what you're doing. That's how it works. And then other times you look like you do, and we put it together, you get a good outcome. So we're willing to take this little bit of pain for these very big rewards. And I'm glad that, thankfully, we appreciate you all taking this journey with us as well, and tolerating, at least to some degree, this kind of an outcome. So one of the points I actually also did not address before, what I want to address now, is the difference in performance between the socially responsible pool and the long-term pool. And so this is, we thought, was a neat way to kind of give you a visual of what this looks like. So what we're doing here is we're actually taking every single 5-year performance period. So everything else I showed you earlier were different time periods that ended June of 2021. This graph and every little dot in those lines is a 5-year period, beginning with the start of the SR pool, which was in 2006, and we started tracking its performance. So that's why it starts in November 2011. That's the first 5-year period. So the blue bar is the long-term pool. The orange bar is the SR pool. And what you can see is, first of all, for a number of years, all the way till about 2014 or so, the long-term pool very consistently and significantly outperformed the SR pool. And by the way, back then we were getting all kinds of questions like, well, maybe the SR pool, maybe the screening's hurting your returns, maybe you just don't know what you're doing. The long-term pool is better. And we argued at the time that the long-term pool does have a larger capital base. It's not as true today as it was back then. It was much smaller, and the SR pool has grown massively. But on top of that, the opportunity set's a little bigger. But our view is like, this is just noise. There are different strategies. There's different managers. This will all be cyclical over time. And then we went into this period where the orange and the blue are literally right on top of each other. And that was sort of what we really expect to see most of the time. And then look to the right, the long-term pool did not do well in COVID. I think some of you may have been on the calls then. We were a little bit ashamed, I will tell you, about the results. We didn't think we'd made any big investment mistakes, but the markets were unbelievably brutal to our value stocks, our non-US stocks, and anything that had any complexity at the time was not pretty. Now you can see that giant mountainous recovery that's occurred. We were expecting that. It happened much faster than any of us would have ever guessed. I'm sure you would agree with that part just in general. But nevertheless, now you'll see there was the period where the SR pool has been outperforming. And it's just, this is cyclical is the point. The long-term pool will outperform again. The socially responsible pool will outperform again. It'll just keep happening and happening and happening. So as you think about your funds and where you want them, I think it should be a question of what investment strategy and approach aligns best with the way you'd like to see your capital invested. And there's pros and cons to both of them. And then one last thing, if I may, the black line in the middle. So the way we're presenting this information to you is, how did you do against a 60-40 mix? And so whenever the blue and the orange lines are above the black line, we're outperforming a simple mix of stocks and bonds, essentially using indexes again. That's different than all those custom benchmarks I showed you earlier, because they're tailored to the foundation's actual asset mix over time in the policy. This is just a simple, hey, let's just throw a 60-40 together to see what it looks like. And so point is, most of the time, and there are exceptions, you can see those lines are both above the 60-40, which gives you a sense that the foundation's asset mix has also been quite successful over time. And we have to execute on top of that as well. I do see a chat question.
Yeah. There's a question. Yeah, you got it, Mike? Custom
benchmark. Yep. In fact, that's a perfect lead in. Oops, I'm gonna come back to that question in 1 minute, and so I don't mess up my flow too much. Thank you for the question. So let's just talk for a second before we get to that question about how this was done. And one point I want to really, really leave you with, and I hope this doesn't come off as at all offensive to Dan, Debbie, or the investment committee. But the secret to great long-term outcomes is to not make this too complicated and to not make this dependent on acts of genius. Not Debbie or Dan or the committee, but investment people frequently like to claim their brilliance when they're doing well, and they're remarkably silent when they're not. And actually, really neither is true. If you have, no one's that brilliant. No one can generate 5, 10, 15, 20 years of brilliance. They can do things where they have natural advantages, take advantage of those things, and just consistently apply a very simple playbook. This is our playbook here. Think long-term, so we don't worry about, that's the first point. How do we preserve purchasing power over 20-year periods? That's what I showed you earlier in terms of success there. 2, this is the big one. Don't be tempted to make changes based on what's happening in the world around you. I'm sure, as you all definitely thought of in your own personal lives, back in April of 2020 and March of 2020, I know I was sitting in my kitchen thinking, wow, this feels very different. It is very different, obviously. How does this affect portfolios? How does it affect the value of investments? It was the most frightening thing I've ever seen, forgetting the pandemic. I mean, I'm not going to talk about that. We'll put that aside. But we stuck to the playbook, which is to not do the logical thing at the time, which is to say, maybe we got to be careful here because this is a really different scenario than any of us have ever seen in our careers. Instead, we said, let's just stick to our strategy because we don't know what the short term is going to look like. And I think that's an incredibly important lesson that you always get from markets. I hope we never get another one like the one we just had. But the reality is that's a central part of the strategy, is to not worry about the short term, other than the fact we feel a deep obligation to all of you to produce. And that does create some conflict in our minds, I will admit, in terms of ignoring the short term. And then last but not least, though, stay diversified. So I'm going to show you the mix now because it's to the benchmark question, but this mix is very diversified. And that's the, and forgive me, this is my expression for me, not any of you, and not the committee, and not Dan or Debbie. This is the ignorant man's answer to investing, or the ignorant person's answer to investing. Is if we knew what was going to do well, we would concentrate our money right there. But since we don't know, we diversify. And this leads to these strategic mixes. So let me tackle the benchmark questions. I don't like to leave people's questions off to the side for long. The way the custom benchmark is calculated is we take these percentages you see here. So for the long-term pool, you'll see 11% by policy is in US large companies. That's the top line. We use the S&P 500 as 11% of our benchmark is that. For small cap equities, we use the Russell 2000 index, 5.5% is in there. And so essentially that's what we're doing, is we're doing a weighted average of this mix using market indices for each piece, except for hedge funds, because we have to use a hedge fund index for that, but it's not a big piece of the portfolio, as you can see. And then we change it only over time, not retroactively. But if the committee tomorrow and Dan and Debbie tomorrow say to make this portfolio 70% equities, that they're not going to, if they did, we would have 70% equities in the benchmark. So that's how it works. It tracks the policy over time with market indices. So that's the answer to the question from before. Now, thinking about this graph, this chart, or say table, excuse me, here you can see some of the differences in the three pools. The first is that the total equities for the long-term pool and the socially responsible pool are about 60% in both cases. The midterm pool is a little bit less at 47.5%. And then the big difference is right underneath that, though, in the bond part of the portfolio. The long-term pool, because it has access to more alternative investments, and also a more diversified, in some ways, set of US public equity investments, excuse me, has a lot less in bonds than the socially responsible pool. One of our goals here is to have these two pools both behave like endowments, which means not just the returns, but also the bouncing around. So we didn't want to be 80%, for example, equities in the socially responsible pool, not because it's a bad strategy, but because it would be very volatile. And we don't want the volatility to be significantly different than it is for the long-term pool. So that's why you see that big difference. The midterm pools, kind of bow to its more intermediate term philanthropic purpose, has a lot of bonds. And we did shorten up some of the interest rate risk in there because we were a little nervous about that, but nevertheless, it's got a lot of bonds, as you can see, and a lot of cash and short-term bonds as well to protect the portfolio from rising interest rates. So last but not least on this page, and I'm gonna pause, see if there's any questions so far, but we also have 5% in Vermont investments in all three pools. Those have been a fantastic part of the foundation strategy over the years. Debbie's had a ton to do with that, and others. The foundation's just an amazing portfolio. And every return you've seen in this presentation includes all Vermont investments that are part of the strategy as well. So I'm gonna take a quick pause. I know Zoom's not easy with questions. And are there any questions so far? Okay.
Um,
Oh, yeah,
are
please.
we-
Hey, Greg.
Yeah, I'm sorry.
No, don't be sorry.
First of all, congratulations. I mean, this is a very heartening set of numbers. Just a quick question. I'm new to this. First time I've been on one of these calls, but the way you're comparing your returns to the benchmark, it really highlights your specific issue selection or manager selection, if you will. You also have shown us numbers against inflation, and sort of on the way you showed us 60-40 straight allocation, all of which look positive. I'm just wondering, how do you or should we be thinking about how much of our return, or how are we doing against some sort of more static allocation, like a 60-40? I mean, is just looking at 60-40 in the CPI, is that suffice? Do you look at it any other ways? Should we be looking at any other ways to capture the asset allocation aspect of it?
Yeah, it's a great question. Thank you for that. And I would tell you, there's a couple things that we do that we're not showing you here, but we're going to I'll make sure we add them in the future, because I completely agree with the premise of your question, which is, there are always multiple ways to think about performance, and you correctly identified how we have kind of segmented it for this purpose. So my answer to you is this, which is that the two things that we do that we're not showing you here in any significant detail or any detail is look at against a 60-40 or a blend of stocks and bonds that has similar volatility to the portfolio. And that might actually be more like a 65-35, just to be clear. So what I'll do next time is a couple things. And I think we may have had these in past presentations. Sometimes I shorten them up because I think, oh my God, there's too many slides. And I'm certainly not trying to take anything out of the information flow, but I get nervous there's too many things. So we'll put that back in there, including the kind of the risk return grid, so you can see the volatility and the way that the portfolios perform. I'll give you the punchline for now, and then we'll show you next time or sooner if you'd like, which is that the portfolios outperformed all these static blends I'm referring to. But let me be very clear. The static blends are global stocks, not the S&P 500, because the S&P 500, we are not concentrated 100% US stocks. I think that's an imprudent strategy personally. And so that benchmark though would have beaten us, particularly over, let's say, 5 and 10 years, just to be clear. So I don't want to leave that out of the equation. Next 5 to 10 years, they're going to be very, very different. And the prior 5 to 10 were very different too. So that's one comparison, is those simple blends, like you said. The second comparison we use, which I will also give you the punchline on, is we also look at how is the portfolio doing compared to other endowments and foundations. And actually, that's been a really, really, again, I'm sort of surprised we put it in here because it would have been a nice thing to talk about. The foundation's been largely top quartile for every time period we've shown you, and in many times top decile compared to other endowments and foundations. So top 10% in all the US endowments and foundations in the database we buy, which is from a firm called Investmetrics that has about 1,000 endowments and foundations nationwide in the database. So those are the two things. The simple mix and other endowments and foundations are pieces that we can and should add to this presentation so that you get a better, more robust view of how the portfolio is performing. I see a couple of questions in the chat. Should I go to those, Debbie, real quickly? The average duration of the midterm bonds, which is so the average duration of the midterm bond portfolio today, I'm going to do this in my head, is just under 5 years. And the Barclays aggregate index is about 6.5 years. So that, just to give you a sense of what that means, for those who don't think about duration. Duration is the exposure to interest rate changes. So if interest rates rose 1% and you had a duration, I'll simplify it, of 10 years, you'd lose 10% of your bonds overnight from that 1% increase in interest rates. If interest rates fall 1%, you'd make 10% of your bonds. So that's why when a duration gets shorter, its volatility gets less. So you might have lost 10% with a 10-year duration. If you had a 5-year duration, like we have in midterm pool, a little bit less than that, you'd lose 5% instead. Of course, you wouldn't make as much if rates fall. So that's why it's a less volatile part of the portfolio, of the return stream. There's another question. Maximum that you will exceed the target percentages for each category. So we, generally speaking, will stay within 3 or 4 percentage points of each of these targets that you see here. And that's the range we use. We typically will use, sometimes there are timing issues where we're actually in the process of exiting something or reducing something in the portfolio that will leave us a little bit around or outside that range, but we're very, very committed to being within those ranges. Big exception, private assets, very hard to control that. And for example, the 5% in the socially responsible pool towards private assets is relatively new. We've only got a couple of fund commitments in there right now, and they take a long time to get invested. Plus, we need to make new commitments. So we're way underweight there. And when we're way underweight something like that, we'll try to substitute in a similar return profile. So we'll own more in public equities as the offset to a below target, exposure to private equity. But we are trying to stay close to these targets. And then one more question that you didn't ask, but I want to ask for everyone is how often do you look at these and do you make changes and how do you make changes? And we look at them once a year with the committee formally. We do not change them every year. Ours is a long-term approach, and the things that drive change are changes in market conditions. Because for the most part, the objectives of these pools don't really change that much over time, so that wouldn't be a factor for us. But what does change is if the S&P 500 were to fall 40% tomorrow, well, the S&P 500 would suddenly get a lot more interesting as a forward investment. If the bond market had much higher interest rates, we would probably want to own more bonds. So those are the things that drive the decision making around these mixes here. But it is basically like watching grass grow, just to be clear in terms of the way we change these mixes. So let me get to the manager side of things, which is an area where our firm is very focused on doing this the hard way. And by that, I mean, we really spend a lot of time looking at everything you can imagine, kicking as many tires as we can, looking under bushes for hidden people. There are a lot of the great investors in the world actually don't have TV ads or any kind of ads, and they're very, very, they're not well known. And a lot of them really are, you have to go find them and you have to actually take the time to convince them that, from our perspective, that the Vermont Community Foundation would be a great client of yours, and you could do something good in this world by supporting the Vermont Community Foundation if you actually are a good investor. I could tell you stories all day, but I won't. But I will tell you this. We've imagined the portfolio right now where we had to wait 8 years for them to allow any of our clients to invest with them because they weren't taking in any new capital. We have one right now. I mentioned to them on the call before we started, I'm going to take a little bit of a travel risk and go to London in 10 days because there's another manager that we have been trying desperately to convince to take money from our clients because he's an incredible investor. And we're almost there, and he's agreed to have coffee with us. And so we've been meeting with him for 4 years, by the way, and he keeps telling us, love you guys, but no. And so we're constantly doing that kind of work. And again, it's a combination though of really two things. One is the begging and pleading that I just described a minute ago. And two, though, is the rigor to make sure these are actually people we want to hitch our wagon to and be responsible for in terms of the performance of this portfolio. So if you are on the team at Crucial, here are the 4 rules that you will follow. You're not required to follow. You know, if they ask, there's not even a question. 1, returns are always accompanied by risk. So our view is not that you can't get great returns without taking risks. So the goal in life is not to avoid risk. The goal in life is to understand it and to make sure that it's acceptable and that you can live with the negative outcome and that the positive outcomes are worth the risks that you're taking. It's an incredibly important nuance of this, and it's all forward-looking. Second point, we have to know what everyone is doing. Even the hedge fund managers we own in this portfolio, we know exactly what's in their portfolios, long and short. And that's important to us because if we don't know what you're doing, then I don't feel like we're living up to our fiduciary duty. I know we're not living up to our duty to all of you. We have to know the key people. I mean, spending time with them. So COVID has been an incredibly difficult time for everybody. And I'm not going to put this at the top of anyone's list, but for us, one of the great frustrations is Zoom is not the same thing as sitting in an office with somebody or having lunch with somebody and having a drink with somebody. You need to get out in the world and see people and spend time with them and read them and see what's new about them, see what's changed about them, watch their facial expressions. There's a million things that go into a good manager due diligence interview. And we need to get on the road, which is why I'm so happy we're sort of back on the road. Third point, where we don't take risk is with operational issues. I hate to keep bringing it up because it's been a while, but it's a good thing to remember. Bernie Madoff cannot happen, obviously, in this portfolio. And the way you prevent that is you have a significant and meaningful, what we call operational due diligence strategy. Our firm has 3 people who do nothing all day, but operational due diligence, and their job is to make sure that the new investments we recommend for the foundation, plus the ones that are already owned, are financially sound investments where your capital is not at risk from theft, essentially, or fraud. And then last but not least, this is a forward-looking process. The problem that most people have when they try to use active managers is they look at the track record. Good track record, good manager. Bad track record, bad manager. That's actually not necessarily true. And that's why the SEC and others require that past performance is no guarantee of future results. Disclaimer. And disclaimer is actually one of the smartest things out there because it's true. Sometimes really smart people have difficult times, and sometimes really dumb people have really good records. Sometimes I will tell you today, just as a side, we were in California last week, 10 days ago, doing diligence meetings, and we were meeting with a lot of tech-oriented managers. And I got to tell you, I've never seen as a group a more incompetent group of people, but they all look brilliant right now because they're buying tech stocks. And if you buy tech stocks, you just have to have a pulse today. Doesn't mean that everybody in the tech industry, as investors go, is bad, but it's the same percentage as every other group. It's probably 10% of these managers that are worth using, but right now it looks like 90% of them are worth using, and that's where our job and yours, if you're picking managers, gets much, much harder. Next slide, I'm going to skip to this. So this is the beginning of the laundry list, just the beginning of things that we look at as the firm responsible for vetting managers for the foundation. Now I'm going to move on, if you don't mind, to kind of what's going on in the world and what we're thinking about, because there's a lot going on right now, as you know, and COVID has a lot to do with it, but it's not just COVID. So the first thing is that to these first 2 points, I mentioned that we don't own that much Apple or Amazon or Tesla. It's not because they're bad companies, they're great companies. The problem is, well, depends on your point of view actually on that one, but they're great businesses. They generate a lot of return for their shareholders, at least Apple and Amazon do. The problem is that everybody loves these things today, and large companies that people are in love with are almost always bad investments on a go-forward basis. That's a very hard lesson for people to accept because frankly, if you're like everybody I know, including us, in some places, you probably own a lot of these stocks because they're big index positions. If you own the index, which is a good thing, you own these stocks. But the problem is right now, there's this massive difference in the level of optimism around companies like those and things like, for example, a European or a German industrial company or a Japanese tire manufacturer. And that is for us an incredible opportunity. I can't tell you how excited we are about when we look at the prices and the valuations of a lot of the businesses in the foundation's portfolio. We have a hard time not seeing 8, 10, 12% annualized returns from here. We look at Apple and Amazon and the S&P 500, we see 4% returns from here. And that's not good enough to get you to CPI plus 5, as you know. And that's why we talk about the opportunity and the trap. And the trap is that it's very comfortable to own the things that have worked. We all love to do it. It feels good. I mean, we all get the same feeling, right? When you have a good investment, makes you feel good about what you're doing, makes you feel smart. You are smart, but the fact is it's cyclical. And sometimes if too many people are smart on the same idea, it's a bad thing. And then there's the last point, which is huge. The amount of speculation going on out there right now is unbelievable. We were actually talking to a private equity manager yesterday who backed Robinhood out of the gates and questioning the model of Robinhood to some degree and its role and what we're talking about, although that's a complicated topic. And the point is that there's a lot of speculation, whether it be crypto, whether it just be meme stocks. It's been a fascinating, I've never seen anything more entertaining, I will tell you, to watch, but it is frightening. And it does have some really ugly perspective implications in terms of what happens next. Bubbles always burst. So let's just take a very quick look at a couple of other things. I think I still have a few minutes for this. So this is the value growth comments I made earlier. So value and growth, just for definitions of value. So the Russell 1000 is a US stock index. They divide it into 2 categories: the value index, which are the cheaper, generally less exciting businesses. They tend to be more cyclical. You'll find banks in there, you'll find energy businesses in there, and the growth index, which tends to have more healthcare, more technology, more exciting businesses just in general, more business that most of us probably like better. But the fact is that what you're looking at, what they're measuring is how do these different parts of the market perform. So what this graph is showing you is it's comparing the 2 great periods of dislocation for growth versus value. One was in the late 90s, better known as the TMT boom. The pets.com boom, we sometimes call it, and then today. So in this case, the turquoise line, which is the TMT period, late 90s, when that line is dropping on the left side of the graph, that means growth stocks are outperforming value stocks. When you look at the blue line, the dark blue line, that's the current manifestation of the same thing. It's not the same today. We don't have pets.com. Today we have Apple, Amazon, Tesla, which is very different and in some ways safer and in some ways scarier. So what you're looking at though, a couple things. So one is it's just fascinating to see how similar those two lines are, including where they bottom, how long it takes to bottom. And that little red section on the far right-hand side of the graph is the recovery in value stocks that really started on what we call Pfizer Monday, which was last year when the vaccines were kind of revealed to the public as being as effective as they appear to be. And so that's what you see. This graph actually is not up to date. It's through May. So there's been a little bit of a dip down for that red line since then. But the interesting things are twofold. One is if you believe in cyclicality like we do, this points to some really good days ahead for those cheaper, less loved type stocks. Doesn't have to be every one of them, of course. You know, energy stocks continue to do badly, but banks might do well. Other cyclicals like home builders and things like that could do very well, et cetera, et cetera. But the point is that that blue line, the way the turquoise line takes off for the next basically 7 years, that's probably what will happen here too. And you might say, well, it's different this time. You know, this is not the same as it was in the late 90s, early 2000s. And that's true, but human nature hasn't changed. And our answer is not that growth companies are bad and value companies are good. It's that investors have taken this way too far. They're paying way too much for the growth stocks. They're paying way too little for the value stocks. And that creates this kind of a cycle that you see here. This is another way of looking at that. So that was just performance we were looking at a minute ago, nothing to do with the prices and the valuations. Valuation is an art, not a science, but this is just a really quick and easy way to think about what you're paying for things. And I'll just cut right to the chase. Price earnings ratio, which is PE, is what are you paying for a dollar of earnings essentially from these two indexes. We're using the Russell 3000 here, which is not that much different than the Russell 1000 despite the name. It's still mostly large companies. And if you look at that blue line, it's way, way low. And that reflects how much more people are paying for growth stocks compared to value stocks today. And you can see the average has been that people pay about 70 cents on the dollar difference. Essentially, that's that midpoint. So about a third more, which makes sense. If a growth stock is growing quicker than a value stock, you should pay more for it. The question is how much more? And today, if you look at where that line sits, it's down near 50 cents. So what that means is people are paying double for just a little bit more growth. And I'll come back to that in a minute. But that's where we object and say that doesn't make any sense. It's financially wrong. It's investment wrong. It is not right. And it will correct at some point. This is the same thing outside the US. It's actually even more extreme outside the United States, but it's the same basic picture. And then here is the point that I really do want to leave you with, which is that if you go back and look at what's actually happened, now we're back to the Russell 1000. That was the graph I showed you in the beginning. It's not that much different than the 3000 again. And you look at where its returns have come from over time. We picked what looks like a weird period of time, which is 1986 to the end of 2019. So why do we choose those dates? Not to make a point, I can assure you. So point one. We have earnings data from 1986. The Russell indices, which we're looking at here, that's what R1000 stands for, were created in 1978, but they didn't publish earnings per share data for the indexes till 1986. So that's why we chose that date. That's the start of the data. We then did do one thing which you might object to or disagree with, but we think was right, which is we'd stop the analysis at the end of 2019. Why did we do that? And the reason was because we don't think the full effect of COVID has been felt yet. And yes, it would make our argument weaker if we ran this today. Just to be clear, I don't want to be fully transparent with you, but our view would be that you got this massive drop off in earnings because of COVID in 2020. We are just now, last quarter and the quarter before, just starting to see the recovery. So I will share this graph with you again at the end of 2021, where I think you'll have more of a real cycle of COVID affecting earnings of value and growth stocks. So we are leaving out COVID and very purposely. And so I want to just make sure that's very clear to everybody what we're doing. Now, take a look at just two things. One is the middle column. How much did earnings actually grow for the growth index? 7.1% per year. For the value index, those stocks grew 5.8% per year in terms of their earnings. And our point is this: yes, you should pay more for a 7% earnings growth rate versus a 5.8% earnings growth rate. No question about it. However, should you pay double? And that's where we, again, as I mentioned earlier, we think that's actually not a hard question. The answer is no, you should not. And that's where these growth indexes and anyone who owns tons of stocks that are in the growth indexes is taking on a pretty big risk, which is that history is wrong. And that price does not matter in investing. As long as something's doing well and a lot of people want to own it and Reddit's pumping the stocks up, it's all good. And I don't think that's how you want to actually treat any of your capital. I know it's not how we want to treat the capital you have at the foundation. And then one more quick thing. take a look at the first column, the first numerical column, price appreciation. So the growth index outperformed the value index by 1.7% per year if you just look at the change in price. Look at the last column, the total return. It only outperformed by 0.3%. What's the difference? And the difference are dividends. Value stocks have much higher dividends, which makes sense. You know, these are older businesses. If they're generating cash, let's hope they return it to shareholders, either through dividends or share buybacks. Growth stocks tend to be, because they're growing quickly, they need that capital to reinvest in their businesses to hopefully accelerate their growth. That's what you'd like them to do with that capital. So they don't pay as much in dividends. And so that's why you get a pretty big closure of the gap, right? The 8.972 only turns into 10.6 versus 10.3. But here is the history of dividends. And this is something else that people have forgotten in this era, which is that dividends can be a really big part of returns over time. And this, we'll get right to the bottom. So this is every decade from the 30s to the 2020s. And you can see when you get to the 2020s, dividends have been a nothing part of return. But most other decades, they're 30, 40%. And historically, they're 48%. Our point is not that they're going to go back to 77% dividends. That's not going to happen given the way the tax code's written today. But the fact is that dividends matter. And value stocks have dividends that growth stocks don't have, and especially if prices aren't going up all the time. These value stocks and their dividends can be extremely good protection for a portfolio. So this is my last slide, I think, which is actually, I don't know how many slides I have. Here's the strategy. The returns we generated, one of the lessons I hope you'll walk away with, the message I hope what you'll walk away with is it's not just, hey, the broken clock is finally right, because everybody gets to look smart once in a while, but the returns, and I think one of those, that consistency graph I showed you was meant to show you how frequently the long-term pool and the SR pool more recently have outperformed their benchmarks. That's a really important part, multiple data points, those rolling periods. So the question is then is how are we going to keep that going? And it's pretty simple. One, stick to the things we've always been doing. Focus on long-term outcomes. Don't let COVID spook us or whatever comes next that spooks the markets. Pay attention. Make sure we own people managing money who are thinking about the companies they own and why they own them and how they're infected by the world around them. That's important. But for the most part, use time as our ally because it is our ally. Second point, scale, i.e. these are both now well over $100 million portfolios, the SR pool and the long-term pool. That gives us a lot of capital, which we can use to diversify these portfolios in a very effective return-seeking way. Second, to relate to that, stability. This portfolio has not changed that much, and the patience of the investment committee and Dan and Debbie are incredibly important. We have some very atypical things we're doing in here. I haven't really gotten to those details. We have a Japanese activist, by the way, who we're exiting, but their portfolio is up 80% year to date. So things like that are happening in a portfolio like this because we can find these people around the world, wherever they may sit, and hopefully stick with them when they're doing really well. Strong components of index funds, as I mentioned earlier. And then the last point is really important, and this was the COVID message, but harder to talk about then. We will go on the roller coaster with this. We'll take on the market risk. We'll accept the fact that people are going to, markets are going to not like our investments at times. But the payoff is what I showed you earlier, which is we'll get paid, and you'll get paid through your funds at the foundation to do the kind of work that you care about from a philanthropic perspective. I don't want to do a commercial for us, but I just want to say one thing. We work for a lot of community foundations. We have about 35 billion of capital. And most importantly, we don't manage money, just to be clear. So everything we do when it comes to advising the foundation is independent. Don't ever confuse independence with competence. They're different, but we are independent. I like to think we're competent, but I'll let the rest of you decide on that. And that's basically who we are. And I'm going to stop now and see if there are any questions that you might have.
Yeah, Mike, I see one question. Yeah, I believe that the PowerPoint should have been sent out to all participants. So I'll recircle back with Kim. And if you didn't get a copy of it, I believe it's on our website along with the audio, which will be posted after this meeting. So Kim, if you hear me and I'm saying something incorrect, let me know. But if not, it should be on our website under the investment, I think, area. Any other questions? Oh, Kim did say there was a link sent yesterday. So if you don't have that, let us know, and you can go to the website and be able to find it. Anything else? Well, great. Well, thanks everybody for participating today. Mike, thanks for your insight It's very interesting. Every time I meet with Mike, I'm always learning more. And of course, like to say that I like the returns you're telling us about as of today. After last year, fingers crossed we get to the finish line. There's never a real finish line, but close out the year, the strong performance to look ahead to 2022. So thanks everyone for joining. We'll be back, I believe it's in December for our next call and our next presentation. And then in between, if you have any questions, always reach out to Stacy's team over in the philanthropy department, or definitely reach out to me and we will connect hopefully in the near future. Have a great rest of your week. Thanks.